Hello everyone, welcome back to Pete's Investing Updates. In this strategy edition, we'll be taking a look at some comparison strategies between the moving average cross and the CCI or Commodity Channel Index, and both are using average down techniques. As always, refer to the playlist to get an update of our strategies. That's where we also publish our weekly updates for the blue chip shares and our weekly updates where we review world indices. In our strategies playlist, that's where you can get some more detail in terms of some basic strategies, in terms of a simple trading strategy, using the average down technique and some money management ideas. As always, click on the subscribe button, the notification bell, and like the video to support the channel. Okay, let's get stuck straight into it. First, I'll take you to the charts as an example, and this is the Commonwealth Bank of Australia. A bit busy, I know, but again, we're comparing three different strategies up here, which these are the profitability charts, and this is the price chart down here, and these are just some of the indicators. So the middle chart here is showing us, this is on a daily time frame. The middle chart shows the moving average cross, the exponential moving average cross. Whenever it crosses over the moving average 20, we buy. So looking at this example here, when the moving average EMA 9 crosses the moving average 20, we buy. And when it drops below, then it re-enters up and crosses above again, we buy another set of contracts. That's what those little steps are. And each of these, we're buying $2,000 worth of shares. So here we bought $2,000 worth there. When the EMA 9 crossed above the moving average 20, we bought another lot there because it dropped below, and then it broke above again. Then we dropped and we entered another $2,000 worth of shares because it dropped below and entered above there. It's a bit hard to read there. I know it's a bit, but I just want to show you that as a very basic. This strategy is basically using the CCI. So whenever it drops below the CCI, again, we're using the CCI 5 on a daily. Whenever the black lines here represent the CCI 5, and that blue line is representing the moving average 14 of the CCI 5. So whenever that moving average of the CCI 5 breaks above, we enter. Hence these blue bars and that brown bar. It's using the same entry technique. The only difference between this top profitability program and this bottom one here, this is using an entry level where it's got to close. It's got to drop over the last 100 days or last 100 bars in this case. The highs and low range. So if the high and low range is say 30, it's got to drop 2 times 30. It's got to drop 60 points before it can re-enter. So if that CCI moving average 14 breaks above 0 and it's dropped at least 60 points, and then after it's dropped 60 points, then you can re-enter it. So you can see here it hasn't re-entered. It's only entered once on initial entry, hasn't re-entered. Let me go find one where it's doubled up. Okay, let's look at these. So you can see here the difference between this strategy and that strategy. I've doubled this one. This says it's got to drop 2 times the last 100 days of highs and lows. This says it's got to only do the last 1 times of the 100 days. So it can actually break only 30 points. It doesn't have to break 60 points down. So again, you can see here this hasn't broken. This hasn't broken an average down at all, because it needs to go 60 points below before it breaks above. This is broken above once over the last few years. Now, why am I doing this? Because you'll see from the profitability, and again, this is the CBA price profitability. You can see here, this is the criteria where it enters and where it exits the trade. And this is saying multiple gap is 1. You can see here the profitability over all these charts of all these companies. It's generated $20,900 over those number of years since the start of 2007. And that equates to about $120 a month on average revenue. Now that's looking at also the drawdown. And the drawdown, which is basically 20,000 over 11,000 drawdown, 20,000 profitability over 11,000 drawdown, that's about 182%. If we go down and look at our EMA 9 breaking above the moving average 20, it's only using a percentage up strategy. That's generating more revenue but it's also got a higher drawdown. So the drawdown percentage ratio is 166. So you can see there from our first strategy, it's 182, which is the higher the better. So in other words, the higher the profit over the drawdown, the better. You can see there that's only 166. And the last strategy down here is 13,000 over 9,000, so it's 149. So what we're trying to do is minimize the drawdown, but maximize our profits. So if you've got the funds, by all means, you can use this strategy as an example. And there's thousands of strategies we can test this with, and I'll be doing that over the coming weeks. But this is obviously generating higher revenue. It's also generating a higher drawdown requirement. This has obviously got a lower revenue, but also a lower drawdown requirement, but percentage-wise, it's a better result. So I suppose what I'm trying to say is, again, we're just looking at CBA in this example. If you look at the big picture, since the start of 2007, CBA in this strategy is generated $2,492. The EMA 9 strategy has generated $11,000, and that's with no multiple of gap. So it's only going down 30 points before re-entering. This has to go down 60 points before re-entering as an example, and it's generating $1,600 of revenue over the period since 2007. And I've gone back to 2007 because I wanted to test the effects of the average down technique during the GFC, but also due to COVID as well. So I didn't want to go back just for a year or 2 years. I want to go back and test the full range for all these, and that's why also I've put in there on an average per month revenue is $120 if you traded this one theoretically, and that includes brokerage in these numbers as well. So let's look at very briefly BHP. So what I'll show you on in these charts here, the profitability charts, you can see here it's averaged down 3 times here during that period. It opened up back here in 2008, kept it for a number of years, averaged down again, and a third time. And this is where it requires a multiple, 2 times the height, 2 times the last 100-day high-low average. And that's what that criteria requires. So it's broken above the EMA 9, the middle chart, and the top chart is CCI 5 with the moving average 15. Has to break above 0, and that's also got to break 1 times the last 100 days of highs and lows. So you can see there that's only entered 3 times, but because we were allowed it only to enter 1 times the last 100 days, it's entered in an extra one average down there. So hence the higher profitability, but also the higher drawdown requirement. This one, because it's entered multiple average downs, you can see that the black arrows, that's where each time it's entered. We haven't applied the, that's this one here. This has gone back and applied the 2 times as well. So in essence, I just want to basically show you the end result. The EMA 9 has generated the highest revenue and the highest ratio versus the other 2 using the CCI. Now this is probably, out of all the 3, I would probably choose this one because it's a nice balance. It minimizes the drawdown, albeit a lower profitability. Now obviously if you wanted to generate a higher income, you could simply change that and then, put in $3,000 per trade or $4,000, whatever you can afford. That would give you a higher yield of revenue, but it would also give you a higher drawdown requirement if you changed your number of shares you bought for each transaction. Okay, I hope that's been some help. In other words, I'm just trying to generate a drawdown requirement and sort of prioritizing what is the best revenue and minimizing your drawdown is what we're trying to achieve here. Thanks guys, as always, click the subscribe button, the notification bell, and like the video, and we'll provide more updates. And if you need a strategy to be tested, again, we always test blue chip shares with dividend yields, and we always use the average down technique. We don't put any stops in there. We would only use stops if we were trading speculative stocks, and speculative meaning they can jump very suddenly and quickly, but also drop very suddenly and quickly, and they usually pay no dividends. So we try to avoid trading those sort of shares. Anyway, that's just my preference. My suggestion: to be safe when you're trading, but also generating revenue. Thanks, and speak to you next week.